Well, welcome everyone. Thanks for coming to our home buyers seminar today. Today, we're just going to run through quickly how to go through the process right from the start of maybe I'm thinking about buying a house to getting a mortgage to working with a realtor and to closing on your deal and moving into your new home. So I'm Heather Smith. I'm a realtor here with the Live Realty Group. And we have Derek Sparrow, who is a mortgage broker, and Cassie Orlando with Live Realty Group as well. So the first thing is maybe you're even just in the back of your mind, how do I even start the process to buying a home? And is it even attainable? So this is when you might spend some time looking at your finances for the first time. Where do I want to be? What do I want in a home? All of these questions. Some people take this time to actually start going to open houses where they can go out and just start looking. What are the things in a home that I get excited about? And just get the mind going and the ideas flowing of what that's going to look like. Once you think, yes, I think I'm starting to get on the right path to buying a home, you're going to start looking again at your finances. And this is when you might start looking into meeting a mortgage broker as well as meeting a realtor. And at this stage, I always say interview as many people as you feel that you need to until you find the right fit. Not everyone is going to be a great fit with every realtor and every mortgage broker. So find the people that you really want to work with and that seem to align with your values and your needs. And because you're going to spend a lot of time with these people and make sure that you feel that it's a good fit. So once you get to that point, you're going to meet with your mortgage broker. And that's where someone like Derek is going to come in. And he's going to run us through what that looks like to start working with a mortgage broker.
All right, so now when you're starting off, you're going to want to decide between a broker and a bank. Now, choosing between one or the other, they're both going to be free to consult with, but the bank is going to have limited options, which means they're only going to be offering their products. Whereas the broker is going to be having multiple lenders with multiple products. And an example of this would be a purchase plus improvements mortgage, where you might think it's going to be straightforward from lender to lender, but each lender is going to have different variables for that option. And so, for example, one lender might let you do 40,000 of improvements, while one lets you do 100. One might let you finish it in 4 months, one might let you do it in 12 months. And so going to a broker is going to give you those options because we're going to have access to multiple lenders. And we have access to the big banks like Scotia and TD, as well as monoline lenders. And so monoline lenders play ball on the same level as the big banks, but they only offer money for mortgages. And so chances are they're going to be able to give discounted rates. We're going to have more product options, and they're not facing the general public. So you have to have a broker to access them. And regardless, both have good options. You just need to figure out, like she said, what is going to be the right fit for you, because this does have to make sense for you. Now, qualifying for a mortgage, there's going to be 5 things that they're going to look at: employment, income, debt and expenses, credit, and down payment. Now, when it comes to credit, lots of times people are worried about how much it's going to impact me to check their credit score. It's only going to be a 4 to 6 point hit if I was to check your credit. And even if I was to check it again, because this home buying process takes a little bit longer, it's not going to be detrimental, and they're not going to penalize you for it. They're generally going to look at it as one home buying situation. And even though it might seem like it's going to be detrimental, even if we have to do it multiple times, it's not going to be that bad. Where it's going to be a problem is if you're checking for me to check for a pre-approval, getting financing for a couch, going to get a car, like multiple places checking it, that's going to have the impact. Now, what is a good credit score? Scores go from 300 to 900, with 650 being average. We need anything above 600 to stay on the A side of lending. Anything below 600, we're going to have to pursue alternative financing. And that's a whole different animal: higher down payment, higher fees, higher rates. If we are on the A side of lending, once we go above 680, we have access to all A lenders. Between 600 and 680, certain lenders will be removed. Their minimum might be 670, 650. But as long as we have above 600, we are on the A side of lending. And this is where it's more of a pass-fail situation than people realize. Because if you have a 680 credit score or a 900 credit score, you're not getting a better rate. You're not getting more pre-approval amount. Once we're on the A side and we have access to the A lenders, we're looking at best options for you. Now, what goes into the credit score? There's going to be multiple factors, such as how many inquiries you've had, the current balances on your debts, how much available credit there is, the length of credit history, also the repayment history, and they all factor in. And so, for example, on the available credit, let's say that you fluctuate your monthly cost on $1,500 a month, but your current limit is $2,000. There is not much available credit, and generally it's thought of as soon as the balance on your credit card goes above 30%, 50%, 70%, or right at limit, you get penalized. So you want to be able to have a lot of available credit, even if you don't plan on using it. And so a way to build good credit would be to use it, pay it off, use it, pay it off over and over, and try and strategize a little bit on that current monthly cost that you have. If it's $1,500, put that limit at $6,000 or $6,500, but make sure that you have the financial discipline to not go above and beyond what you would regularly spend. And in terms of the impact of late payments, there is an element of having a challenge to discuss with the lender of showing proof that they're going to pay this mortgage on time when we have a whole bunch of late payments on credit cards or lines of credit. There are situations where it can make sense, such as if you went through a divorce in the past, say in 2021, there was multiple lates for a short period of time. Now, because we're going to have that divorce agreement, part of the story talking to the lender is going to say, well, they went through a divorce in 2021, there's a few lates there, but there's been excellent repayment since. So there are moments where it can be okay, but if those lates are peppered throughout the most recent history, it is going to be difficult to explain if there's not a good story behind it. Now, in terms of the mortgage stress test, it's something that has to happen for every single borrower. It doesn't matter if it's a purchase, refinance, or renewal. We have to qualify you off of a higher rate than what you're actually getting. And that rule is taking either the Bank of Canada qualifying rate of 5.25 or your rate plus 2%, whichever of those is higher. And that's what we're qualifying you on. Now, because rates have gone up so much in the last few years, when we're getting you a rate of 5% and we have to qualify you off of 7, the purchase price that you are approved for starts to get tested a little bit. So as those rates go up, the qualifying rate goes up, it gets tighter. As it comes down, it gets a little bit better. And where that comes into play is the two ratios that we have to make sure are in line for the mortgage application. There's the gross debt service ratio and the total debt service ratio. Now, the gross debt service ratio is a combination of mortgage payment, property taxes, heat, and condo fees if it was a condo. And the total debt service ratio is all of that plus any other debt that you might have. Credit cards, lines of credit, car loans, student loans, support payments, both child or spousal. And as a general rule, we need the GDS or the gross debt service to be under 39% of your total income, and we need the TDS to be under 44% of your total income. And generally, the lenders are pretty strict on that. If it goes over just a little bit, most likely they're going to say no. There might be extenuating circumstances where we could make an impact, but we want to be under 39% for GDS, under 44% for TDS. And talking about debts, how they impact the application is going to depend on the type of debt that it is, because credit cards and lines of credit are going to be different than loans. A credit card and a line of credit, we have to use 3% of whatever the current balance is for that monthly payment in the application, whereas loans, we use whatever that payment is. Whether it's a student loan, car loan, or personal loan, whatever the payment is, we get to use. Whereas if the credit card or line of credit, chances are your minimum payment is going to be far below the actual payment that we have to use. The exception to this would be student loans. If they're not in repayment, this is where a lot of people think, well, they're not in repayment, I don't have to worry about it. But if they're not in repayment, depending on the lender, we still have to use a payment of either 1.5% or 2% of that balance. So if you have $30,000 in student loans that are not in repayment, we'd be looking at a monthly payment of $450 to $600, whereas chances are once it's in repayment, it's probably going to be $100 to $150. So it severely impacts the pre-approval amount that you could be looking at. And the same goes for paying off that debt, because credit cards and lines of credit, we're basing it off of the balance. As you pay it down, it has an impact, whereas a loan, it has to be paid off completely for it to be removed from the application altogether. Now, talking about loans, the weight of a car loan. A lot of people don't realize how much it impacts the pre-approval amount. And so I'm going to give you 3 situations, and all of the variables are going to be the same except for the car loan part. So we're going to say an annual household income of $100,000, minimum down payment 5%. We're going to do a 4.99 rate, 25-year amortization, and all revolving debt gets paid off monthly. So credit cards and lines of credit get cleared at the end of the month. If you were to have no car loan, we'd be looking at a $405,000 pre-approval amount. With a $650 a month car loan, your pre-approval amount is going to go down to $375. So you just lost out on $30,000 of buying power. If there was an $850 a month car loan, that pre-approval amount would go down to $350. So you just lost out on $55,000 a month. Now, these 2 car loans that I used are not big. They are very much middle ground, considering I see car loans that are up to $1,300 a month. So I tried to tell this to people. I know it sounds crazy, but buy a home before you get a car loan. Like, if you have a desire to get a nice car, please wait until you get in your home, because the car loan has a huge impact. Now, when we're talking down payment, we need 90 days bank statements of whatever account the down payment is in. So if it's in 4 accounts, we need 90 days bank statements for all 4 accounts. If it's in 1, then we only need that 1. Now, lots of people hear that and they think, I'm going to try and move it all into one account. Please don't, because anytime there's a transfer over $1,000, we have to track it. So if you're moving it from 4 accounts into 1, we're still going to have to get the 90-day statements for all of those accounts. Once down payment is signed off, then you can move it all into one account, make it easy for paying and taking that money to your lawyer at the end. But if you can, wherever it is right now, when we have to track it, just leave it there, 90 days bank statements for all of those accounts. Now, when we're talking about gifted down payment, it has to come from family or legal guardian. There is an opportunity where if it's a really close family friend and we have a good story to go along with it, we could get that in, but most times it has to come from family or legal guardian. And on this note of down payment, there's 2 government programs to take advantage of. There's the FHSA and the home buyers plan, taking out of your RRSP. With the FHSA, you can pull $8,000 or put $8,000 in a year. Since it's only been in effect for 2 years, you can take $16,000 out. It'll max out at $40,000. The HBP plan, you can take $35,000 out, but there is a projected request that hasn't been in effect yet to take $60,000 out. Not sure when it's going to take effect, but it should be coming soon. Now, other important things to consider: interest rates. If we're talking a fixed rate, it's going to stay the same for the whole term, whether it's a 5-year, 4-year, 3-year, whereas variable is going to be structured something along the lines of, say, prime -1. Now, that -1 discount, that's going to stay the same for the whole term, and prime is what has the potential to change. Now, prime is directly impacted by the Bank of Canada qualifying rate, and so there's 8 meetings a year to determine what to do with that, and those meetings are set in stone. We know when they're going to happen, and they're going to either increase it, decrease it, or keep it the same at one of those meetings. And so as soon as there's a change, you would see a change to your variable rate. Now, lots of times people think that because there are those Bank of Canada meetings, that's the only time that rates are going to change, which is not the case. They can change at any time. Now, for example, I took the last year, 2023, and looked at the emails that one particular lender sent me, because they send rate emails constantly. They sent about 135 rate emails throughout the year. And They change their rate 60 times throughout the year. So they do not wait just for the Bank of Canada rate announcement. So if you're thinking about making a move, if you're thinking about getting pre-approved, anytime that home buying just starts to pop into your head, that's the time when we need to get something locked in. We're not waiting, well, the Bank of Canada rate announcement is in a couple months, I don't need to worry. No, we need to worry now, get something on hold so that we're safe in case rates change. On the note of closing costs, typically the lender wants to see 1.5% of the purchase price for closing costs on top of down payment. And so that's going to take into account the appraisal, the home inspection, the legal fees, as well as the first month mortgage payment. I even had a lender comment to me one time, like, how am I supposed to believe that they can furnish this home? There is just not enough money there, and you can't assume that you're going to put it on a credit card, because if you can't qualify with debt right now, you're not going to be able to qualify or be able to carry the home with that future debt. So we want to have 1.5% on top of down payment. Now, other important things to consider, your down payment is going to change, your minimum down payment is going to change depending on the purchase price. So 5% up to $500,000. If it goes above $500,000, 5% on the first $500,000, 10% on the remainder up to $1 million, which would be 20% down payment at $1 million, and then there's a sliding scale if it was to go above $1 million. Please note also that your documents can expire. Now, depending on the document, so for example, the letter of employment is good for 30 to 60 days, depending on the lender. Pay stub's good for 14 to 30. So if this home buying process takes 3 months, 4 months, I will need some of the documents to be refreshed. So just be prepared that that will be a requirement. And please, please, no changes to the details of that the pre-approval is based on. Employment, income, credit, down payment stays the same, because you don't know what kind of worms you're opening up. If you're accepting a job, or you're spending some of that down payment, or you're going to get a new credit card, that can throw the whole pre-approval out of whack. There are situations where if you are staying in the same industry, same role, but it's better pay, it could work, but please, please talk to your broker first before you decide to actually pull the trigger on that new job. This is also an important note that any debt that's owed to the CRA must be paid in full before any mortgage is going to go through. It can't be on a payment plan, paid in full. Essentially, the government takes precedent over the lender, so they're not going to accept if you owe any money to the CRA. And this is a note that some people have a hard time understanding, is your income does not determine the rate that you get. Doesn't matter if you make $70,000 or $100,000, they're not going to give the person who makes $100,000 a better rate just because they make $100,000. Your rate is going to be determined by things like the loan to value, the down payment, term length, amortization. It's not going to be based off of income. Pass it off to you.
Thank you. Thank you for that information. So congratulations, you've been pre-approved. You've been working really hard with your mortgage broker. You've been sending in all the documents, and now it's time to go house hunting. The first thing you need to do after you've connected with your real estate agent is have them set you up on a safe search. After you find that property, you're going to go out and look at it, and if you do make an offer on it, you're going to most likely have conditions, and one of those conditions is going to be a financing condition. We typically leave 2 weeks for financing, and that gives enough time to get all the information into your bank or mortgage broker, and once you are approved for that financing condition, we remove it.
So after you've removed your conditions and now that your deal is firm, so now you just have that space between firming up your deal and getting to closing day. So during that time, you're still going to be communicating with your realtor about things that are going on. You're also still definitely going to be communicating with your mortgage broker, who's still going to be running things, making sure that everything is good leading up to close. At this point too, you're going to be dealing with your lawyer. There's going to be a lot going on, but that's why your agent is there. They're going to walk you through every step of the way. And once you get to closing day, your lawyer is also going to walk you through that day. You're going to sign some papers. Your mortgage broker, again, is going to be in touch with you to make sure everything goes smoothly. The money is going to transfer hands, and then the home is yours.
So once financing is removed, can I buy a car?
Absolutely not.
Oh.
Don't do it.
You told me to wait and then I could buy a car.
once you are in the home, once it closes, then you can buy a car.
Okay.
Then spend all the money.
Can I buy furniture?
Once you are in the home, nothing before.
No furniture?
No, not ahead of time.
Thank you all for coming to our home buyers seminar. If you have any real estate or mortgage questions, please give us a call.
But can I ask you now?
Yes. Any questions?
Please ask questions now.
Is the process for buying a foreclosure any different in terms of lending? And then,
On our side, it makes it very difficult because chances are you're not going to be able to get an inspector in there. There's not going to be that sort of certainty that everything is going to go good. So there could be potential where we might have to need or might need bigger down payment because we might have to go to a different lender because the initial lender said no because of something that came up once you did finally get into it. And chances are you're going to be on an unconditional offer. So ideally, if we're looking at a foreclosure, we're doing it somebody who has 20% down payment, because then if A side fails, we have B options, which will be a whole lot easier. It's very nerve-wracking if somebody who is getting an insured mortgage is trying to get into a foreclosure, because there's just so many unknowns and so much that can come up in that process. So it can happen, but ideally 20% down payment, then we have options, or at least just being prepared that you could be in this situation, or maybe you have family to fall back on to increase the down payment. Just safety plan if you are going for the foreclosure route.
so no fixer-uppers.
No. Well, I mean, fixer-uppers, you can do the purchase plus improvements product, right? Like as long as it's still livable as is. If it's a foreclosure, then that's a different element.
What if I call you guys? I mean, is it a good idea to call realtors whose names are on the houses to show me the house, or like how does that work?
I would say, as a general rule, the way representation works is the listing agent is representing the best interest of the sellers. So as a buyer, you really want someone who's working just for you and has your best interest top of mind. So they represent just you, they owe you all of the duties. If you do go to the listing agent, their first priority is the seller. So I always suggest, best case scenario is you have your own agent.
But I heard that you get a better deal if you use the same realtor.
I get that a lot. Definitely not necessarily. And again, it's are you covered and are you being represented? Maybe someone, you've heard of people in the past who have gone to the listing agent directly, and then the listing agent cuts their commission and it brings down the purchase price.
So if I choose one of you guys to be my realtor and I list my house, do I still need a pre-approval to get into my new house?
Yes, very much so.
But why?
Well, just because you own this home doesn't mean that you are good to own your next home. You still got to go through the qualifying process. We still need to make sure that everything is as you say it is, as you make it seem to be, like it's going to be good. And we need to confirm that if down payment is coming from sale proceeds, that you have enough to move forward and everything like that.
So I just signed up on a bank website, and the page that I entered my income in told me that I can qualify for $600,000. So I'm ready to go, right?
I bet you get that a lot, actually.
Why is it wrong?
Well, because it doesn't take into account anything in terms of debt, how they're actually coming to that income number. Like when we're looking at somebody's income, if it's salary and it's guaranteed on the letter of employment, great, then we can say that. But if it's somebody who's self-employed, we have to use the previous 2 years to establish a history. And lots of times, self-employed individuals will give themselves as many tax breaks as possible. So what has come into the company is not actually what they paid. And that has a drastic difference between like 80,000 that came in and you're paying yourself 40. You're not looking at the same type of home based on that income amount. So chances are, if it is somebody self-employed, they're putting a number that is not actually what we can use for the income in the application.
Great.
I just saw a house online, Cassie. Can we go see it in an hour?
Most likely not. Most of the time, the sellers would like 24 hours notice. How'd I do?
They need some notice, yeah.
Yeah, okay.
But I'll see what we can do.
Yeah.
So what's the difference between, like, if you needed bridge financing, remember you owned your home, you wanted to buy another one, and you need an extended bridge financing, how difficult is that to get?
Not very difficult. I mean, most lenders offer bridge financing. The key to it is making sure that we have 2 firm closing dates. So a firm closing date on your sale and a firm closing date on your purchase. And then whatever those dates are, you will just get bridge financing for that 2-week period, 1-week period, 1 month period, whatever it is. So as long as we have the firm closing dates, it's all good.
I've heard bridge financing is really expensive.
Not really. I mean, like, there's going to be a baseline fee depending on the lender, $250 to $450, and then like 4% of the balance for however many days. So I guess there could be an opportunity or a possibility that it is expensive if your down payment is $300,000 coming from sale proceeds, but it also depends on how long that bridge financing period is. You generally don't want it to be months on top of months. So not too bad, considering that you're getting a lot of money being able to be transferred to the new home.
Can I see houses without a pre-approval? Do I need to be pre-approved before I offer?
I mean-
I've heard of people who have offered and weren't pre-approved yet.
I mean, I'm sure that does happen. Like, ideally, you are coming to the mortgage broker first, and you're finding out what you can get pre-approved for. And not only just to make sure that your income is good and credit is good and all of that, but there's also, I would say, like an emotional component. Because if you go to your realtor and you're looking at a $500,000 home, and so they put you on a search and you're seeing $500,000 homes, and then you go to get pre-approved, find out you're only looking at $350,000 homes, there is going to be a letdown. You are going to be comparing a $500,000 home to a $350,000 home, and it's going to be hard not to have some negative feelings attached to that. Whereas if you get pre-approved first, you know what you're looking at, then that's what you're taking to your realtor, and then they're providing you with options. So you're looking at homes that you can qualify for. It's a much smoother process. There's no disappointment. It's just better all around.
Yay, thank you.
Thanks for coming.
Thanks for coming.
Yay!